Welcome to Trader TV, I'm Dan Barnes. Repurchase or repo markets are a vital short-term supply of liquidity for borrowers and a source of revenue for lenders, yet there are serious concerns over their capacity to function. Joining me today are Roelof van der Struik, Manager for Treasury Trading Commodities at PGGM, and Andy Hill, Senior Director at the International Capital Markets Association, Market Practice and Regulatory Policy Group. Andy, Roelof, welcome to Trader TV.
Hi Dan, good to be here.
Hi Dan, thanks for asking me back.
So the first question is, what is the significance of the performance of the repo market today?
I said this last year when I was with you in August. During the year, nobody wants cash. And everybody wants bonds.
Right.
But as I also said last year, when the fertilizer hits the air conditioning, yes, then suddenly nobody wants bonds, everyone wants cash.
Yeah.
So we need a mechanism to transform the one into the other. And that's called the repo market.
How have the repo markets been functioning over the past year?
If you look at the market on any given day, particularly over, say, the last 2 years, it might look as if it's functioning pretty well. If you look at the ICMA semi-annual repo surveys, for instance, the last one showed that outstanding repo balances in Europe are at 7.6 trillion, which is the highest they've ever been. It's higher than pre-regulation. But you also have to remember that a lot of this is being driven by the margin requirements. So
that's for derivatives trading.
For derivatives trading.
Yep.
So, and also a greater emphasis on secured borrowing and lending rather than unsecured, as the unsecured market virtually goes to zero.
Yeah.
But the problem is, underlying that is, I guess, a structural weakness or a structural vulnerability in that once you get to key reporting dates, year-end being the notable one, things start to break down.
Could you just explain the risks for your members?
I think the risk has actually, as a result of regulation, moved from the sell side to the buy side. Mm-hmm. If you think about what banks do in the repo market, they provide an intermediation service. They provide transmission. It's the users of the repo market who are most vulnerable.
And that's primarily corporate treasurers and investment managers?
Absolutely.
Right, okay.
I think it's also important, how do banks see themselves? Do they see themselves as shareholder-owned money factories, or are they monopolistic utility companies?
Sure.
And I think and we're hoping that the utility companies and the banks are saying, no, we are here for our shareholders and trying to make money. If we would have some kind of backstop, it doesn't matter how expensive it is, but at least have some kind of way of, in case of extreme market conditions, to tap into the ECB liquidity, then it would give us enormous peace of mind. By the way, that's the last time I'm going to call wolf. We've been screaming wolf for the last 5 years. It hasn't helped. So we're going to stop doing that, I think, and just start praying or something.
Andy, are there any solutions that your members have collectively put to you, or lobbying positions they've asked you to take?
They have. Whether they're acceptable or not is another question.
Sure.
I mean, there's lots of talk about disintermediation of the banks. If the banks are the blockage, if the regulation and the other reporting requirements and the balance sheet levies are what's causing this inability to intermediate and create collateral and liquidity fluidity, then surely the solution is to go around the banks. In theory, it sounds fine. In reality, it's practically impossible. The banks essentially provide this immediacy service by using their balance sheet.
Yep.
They take risk. They bid for terms that are mismatched. They bid for collateral that's mismatched, offer collateral they don't own.
Yeah.
They manage this risk, they hedge this risk, and then they trade out of it. That provides the immediacy that the market requires. If the banks don't do that, who else will? You need balance sheet, you need traders. It's an impossible conundrum.
Our idea of a bank is that because they can net across a whole bunch of customers, they can be of great value.
Yes.
But if they are not in a position to do what they're supposed to do,
yes,
either by the shareholders who don't accept the lower return on equity that this product is providing, or because the balance sheet restraints for the regulator, then we are in trouble. And then we can try. I mean, you know, we've spoken about, you know, peer-to-peer initiatives and everything, but I think, I mean, the regulator also calls us shadow bankers. So I mean, well, what do you want? You know, we would love to have banks that do the work for us. Yeah. But now we are trying to figure out how we can be a kind of bank, which we don't want to be. We are investors.
Absolutely.
So it's a very strange place.
Okay. So what are the possible ways forward?
It's never well accepted by regulators, but there is clearly an argument for a rethink about how things such as the leverage ratio are applied.
Yep.
That's not to say the leverage ratio should be taken away. It's just, should there be exemptions for certain activities where you're not necessarily providing leverage, but you are providing a service that is fundamental for the functioning of the financial markets. I think there needs to be a recalibration of some of the regulatory requirements, leverage ratio being the main one.
Andy, Roelof, thank you very much.
And thank you for having me.
Thank you.
I'd like to thank Roelof van der Struik and Andy Hill for their insights, and of course you for watching. To catch up on other markets we cover, or to subscribe to our newsletter, go to tradertv.net and etftv.net.